India, an emerging market economic power known as the outsourcing center of the world. Inflation, a burgeoning fiscal deficit, and widespread poverty still hinders the near 1.3 billion people nation from growing faster. Join us this weekend as CCTV speaks to India's central bank governor, Devuri Subbarao. He shares his views on how to boost economic growth while curbing inflation and how India intends to help its poor through finance. Only on Biz Talk.
We are standing in front of the India Gate in the heart of New Delhi, India's national monument. Built in 1931, it was inspired by the Arc de Triomphe in Paris. Today, India is in dire need to revive economic growth and trim the fiscal deficit in order to reverse the worst slowdown in a decade. GDP growth tumbled to 4.5% in the October to December quarter, far below previous years. Global credit rating agencies Standard & Poor's and Fitch have even threatened to downgrade India's sovereign credit rating to junk. At this critical junction, I will talk to the Governor of the Reserve Bank of India, Devuri Subbarao, about the weakening growth, the 2013-14 federal budget, and the wide fiscal deficit.
A population of more than a billion mouths to feed and take care can never be easy. But its biggest problem remains inflation. Consumer prices are rising at over 10%, and that is impacting the common people. Coupling that with the economic slowdown, unemployment and the absence of salary hikes, the man and woman on the street are not happy.
The economy is really taken a backseat. It has not been same as it used to be 2 years back. The people are basically sitting on their money, I guess. The money is not rolling in the market.
As India plans to get more money by opening up various sectors, even that path is not likely to be easy. Political opposition will slow this process down. Though India has seen some fiscal consolidation, reviving growth will still take some time.
Your Excellency, Governor Devuri Subbarao, thank you very much for your time.
Thank you very much. Delighted to be on CCTV.
You were appointed governor in 2008 at a time when the global financial crisis unfolded. How would you describe India's financial and economic trajectory over the past 5 years?
Well, the short answer to your question is that India's financial and economic trajectory over the last 5 years has been extraordinarily challenging and complex. If you just look back before the crisis, India clocked an average growth rate of 9.5% in the 3 years before the crisis. So the India growth story was taking shape. But that got interrupted by the crisis when growth plummeted to 6.7%. But we recovered from the crisis much sooner than most other countries. But inflation too caught up with us ahead of other countries. But growth held up in the first 2 years after the crisis because of the surge in private consumption demand. Over the last 2 years, though, there has been a slowdown, and today the macroeconomic situation is quite complex. Growth is moderated, inflation is still high and stubborn. The current account deficit is going to be historically the highest, and most worryingly, investment has decelerated. So I would say that at the moment the situation is quite complex, but I also want to add in conclusion to this answer is that the India growth story is intact. Provided we do the right things, we can get back to a high growth trajectory.
And what are these good things that you're planning to do to boost the economy?
Well, the most important thing that must happen is a revival in investment. We need both domestic and foreign investment. And for that investment to take place, there's a lot of things that the government has to do. For example, the supply constraints, especially in infrastructure. Then there is the question of governance concerns, governance reforms in terms of approvals and permissions required to start an enterprise. That's got to be speeded up not only in Delhi here but across the states. then fiscal consolidation has to take place in order for credit to flow to the private sector.
Coming back to growth very quickly, what is your real GDP growth forecast for the fiscal year 2013-14 starting in April, and what will be the challenges and the key drivers?
Compared to this year, we expect growth next year to be higher because we're seeing some spring shoots because of the fiscal consolidation that's been affected in the budget. Because of inflation coming off from the peak, we can expect investment to take place. On the net exports, I believe that with inflation coming down and also the customs duty raised on gold, the import demand for gold will come down. With the adjustment of petroleum product prices, particularly the price of diesel, some demand adjustment must take place there. So with an increase in exports and some reduction or at least deceleration in imports, we can see some improvement in net exports as well. So on investment, consumption and net exports, we will see improvement next year, and growth should be significantly higher than what it is this year.
India's consumer inflation and wholesale price index, the measure that the country uses to calculate price changes, is among the highest in Asia. What is your inflation outlook for 2013, and what are some of the price pressures, and what is the RBI planning to do to control the pressures?
Today inflation is below 7%. Core inflation too has come down to just about 4%. So we believe that going forward, over the short term, when I say short term now, I mean the next 6 months, inflation is going to come down or hold steady at this level, or if it comes down only gradually. The Reserve Bank, in its monetary policy, has to respond to the trajectory of inflation as well as the growth outlook. So we will try to balance between growth, inflation. And one other important thing in designing monetary policy is the size of the current account deficit. You probably have a question on that, but since this is a question on inflation and monetary policy, I must put that in the context that the fact that current account deficit this year is going to be high limits the room for monetary easing to that extent. As much as there is some justification as well as room for monetary easing because of growth inflation dynamics, that is limited by the size of the current account deficit.
When the Indian Finance Minister stepped into Parliament this year to unveil the budget, he faced a double-edged sword. On one hand, he was forced to introduce measures to boost India's growth, which is staring at a decade low, and on the other hand, he had to tackle a skyrocketing fiscal deficit, which meant no big bang schemes. The astute Finance Minister P. Chidambaram did manage to walk the tightrope by doing all he could. He managed to keep the fiscal deficit at 5.2% for the year 2013-2014, which starts on April 1. To achieve this, the government will impose new taxes on the rich and large companies. One of his biggest tasks was to prevent a reputation loss of India among international investors.
Investment is an act of faith. We will improve communication of our policies to remove any apprehension or distrust in the minds of investors, including fears about undue regulatory burden or application of tax laws. Doing business in India must be seen as easy, friendly, and mutually beneficial.
Despite fiscal deficit being tamed, the current account deficit still remains a huge concern. India's current account deficit widened to a massive $22.3 billion in the quarter ending 30th September. The gap has narrowed since, but just enough to save India from any further credit rating downgrade.
As far as fiscal deficit is concerned, yes, the budget would be successful, and last year also we have been successful. Now comes another issue, current account deficit, dollar rate and all those things. There, I think still there needs a question mark. There is a question mark because as of now, either we need to improve our exports or we need to compress our imports. Now, both things seem to be very difficult.
Adding to that is the worry of a weakening rupee that has started to alarm trading firms. Furthermore, India's international image has been taking a hit due to the lack of policy stability. Some say allowing more foreign direct investment into the Indian market could help improve the situation.
Even Indian investment cycle had kind of cooled down substantially. And going forward, how do we create a framework which is basically kickstarting that investment cycle so that it can continue over a longish period in terms of helping the growth and getting the employment and getting the consumption in right places.
A very hot topic obviously has been the 2013-14 budget of India. It was unveiled in February, showing that total expenditures will rise by 16% to around 300 billion US dollars. It pretty much surprised markets also by imposing new taxes on the rich and the large companies. What kind of impact will such expansionary budget have on the economy as well as monetary policy going forward?
Well, I'm struck by the word that you used, expansionary budget. Actually, I wouldn't call it expansionary because even as you said, expenditures have expanded, so have revenues. And indeed, revenues in the budget estimates, there is a much larger expansion of revenues than expenditure. So to that extent, the budget represents a significant effort at fiscal consolidation, down from 5.2% in the current fiscal year to 4.8% of GDP in the year ahead. There's one other question that people have raised about fiscal consolidation, about whether its impact on inflation actually, because the argument is that fiscal consolidation is coming out of cutting subsidies and desubsidization is inflationary. So what you're gaining, you might, by way of lower fiscal deficit, you might be losing because of higher cost of presently subsidized administered price products. Yes, it's inflationary in the short term, but that inflation impact should even out in the medium term, let's say beyond 1 year. Also, by reducing subsidies, you're removing distortions in the economy, sending the right price signals, so demand will adjust too. I don't think, therefore, that we should exaggerate the inflationary impact of desubsidization.
What further measures should the government take to lower the fiscal deficit and create more fiscal space?
Well, that's quite obvious too, because you reduce fiscal deficit by raising revenues or lowering your expenditures. Raising revenues, all the big ticket items are on the table. The goods and services tax, the direct tax code, and a lot of other measures to rationalize the tax structure, improve the tax base, and improve tax compliance. Okay? Those are the things to be done on the tax side. On the expenditure side, even as expenditure is going to be cut, I think it's very important to pay attention to what expenditure you're cutting. The Reserve Bank has consistently held that as much as the quantum of fiscal adjustment is important, the quality of fiscal adjustment is equally important. So what expenditure you cut is important. You must cut unproductive expenditure and indeed increase productive capital expenditure. So I believe that's what the government must be doing.
A 2-hour drive from the Indian capital takes you to a village called Halambi Kala, a village trying to make its own little world. Meet Lakshmi Devi. She moved here after her makeshift house in a slum in Delhi was evicted to make way for a flyover. Her move to this village left her with nothing. That was when she realized that a small bank in the village is giving loans to women. Her first loan was for less than $200 to start this small grocery store. Today, she is on her third loan cycle and her living standard is improving every day.
When I first came here, we had no money, and then this bank really helped us. Since then, I have made my own house, have my own shop, and also own a small piece of land.
There are many in this village like Lakshmi Devi who have managed to make a life thanks to microcredit. Fusion Microfinance is a startup company that builds microfinance institutions in villages in North India. With 30 branches, the institution empowers families through women. Loans are given in the range of $200 and $600. Most are used to build an already existing business or to start a new one. Rashida Banno is the bank manager of this branch. She says it's the quality of life which is the most prominent change that microfinance has brought about in this village.
Slowly we increased our loan size. We started from 2,000 and today we start from 12,000 rupees. We have seen they always put it to good use and improving their family life. Ladies are also working now.
North India has less than 10% penetration of finance, even though more than 60% of its population is poor. Most private sector banks in India shy away from giving loans to farmers directly, even though the Indian Central Bank (RBI) has said that at least 1/4 of branches of new banks should be in rural India. In the past 3 years, even when RBI was increasingly forcing banks to spread services to the unbanked rural markets, there has not been much progress in money flow to rural customers. The gap is being filled by microfinance companies that cater specially to their needs.
40% still people do not have bank accounts, and overall there's a huge number of people where the formal banking channels have not reached. So this is where microfinance plays a role by providing a low cost debt financing in a very dignified manner, and also timely credit, so that they are not dependent on the unorganized sector.
Indian private banks have tried to stay away from directly lending to small farmers and weaker sections in far-flung areas. They achieve their priority lending obligations by buying out loans from non-banking institutions or by investing in rural infrastructure development funds. But as India's growth starts coming from micro and small enterprises and its government aims towards inclusive growth, small loans and microcredit is the way forward.
Now, in 2010, the World Bank issued a report estimating that around 33% of India's population lives below the international poverty line of $1.25 per day, and around 70% of the population below $2 per day. What is the RBI and what can it do to cut and reduce poverty in the country?
That will happen only if there is financial inclusion. It's not as if it's going to happen and then we got to include them financially. In fact, 200 million people in India coming out of poverty will be conditional on the government and the Reserve Bank providing access to financial services to these hundreds of millions of poor people. What we're doing in order to do that is first to make sure that there is access to finance to these people, either through a brick and mortar branch or through a banking correspondent. Second, we are encouraging banks to make sure that this does not degenerate into a target-driven program, that there is meaningful financial inclusion in the sense that when a bank account is opened, that bank account is used actively for remittance, for saving, for getting credit, for getting microinsurance. Third, we are spreading awareness through a very comprehensive financial literacy program at all levels, for adults, for children, for the bank customer groups, for the self-help groups, for the microfinance institutions, through financial literacy camps, financial literacy counseling centers, etc. So our strategy is both improve access and increase awareness so that the financial inclusion becomes meaningful.
What kind of specific initiatives have been launched in terms of microfinance and small loans?
Microfinance multiplied or expanded very rapidly. Certain malpractices had crept in, which were most visible in Andhra Pradesh in 2009-2010 in terms of allegations of very high interest rates, irregular lending practices, coercive recovery practices, etc. In response to that, the Reserve Bank appointed an expert committee chaired by one of our central board directors, Mr. Maliga. There are prudential regulations, there are entry-level norms, there are provisioning and capital requirements, and most importantly, there is an interest rate prescription. So a whole lot of things, both by way of regulation and moral suasion, that we've done to improve the quality of microfinance lending in the country.
Now, last year the Parliament passed a bill to liberalize the banking regulations, and big conglomerates in India such as Mahindra & Mahindra or Reliance or Tata Group have already voiced their interest to actually transform their financial arms into fully fledged banks. What kind of impact would it have on the banking sector and the economy as well of the entry of such big conglomerates getting bank licenses in the country?
One of the important things, the hallmark of this set of guidelines for bank licenses, is that we have opened it to corporates. Last time we did this in 1993 as well as in 2001, corporates were ineligible for applying for a bank license. This time we made them eligible. In order to get the necessary capital into the banking sector, and also in order to get the wealth of experience of Indian business into the banking sector. There are concerns. People have expressed concerns about whether there will be some self-dealing between the corporate promoters and the bank that they promote. But I believe that we've instituted a number of safeguards in the draft guidelines to prevent that from happening. I don't want to go into all of them, but by far the most important is that we have prescribed very stringent fit and proper criteria. Only applicants with a sound credentials and a successful track record and with a business model and business culture that is consistent with banking, only they will be screened. There is a clause prohibiting lending by the bank to the promoter group. There are restrictive clauses about the number of independent directors required, etc. So I believe that all these clauses will be sufficient insurance against some intermingling of the business of the promoter group and the bank.
For India, the international economic environment has become important after its own economy started to suffer. The focus is on reviving global growth, reform of economic institutions like the World Bank and IMF, ways to promote investment in infrastructure and sustainable development.
The emerging economies are affected not only because of a fall in international demand for their products, but also due to a slowdown in major emerging economies like China, a fall in commodity prices, efforts to rebalance demand towards the domestic economy, and an uncertain global environment. The immediate fallout has been a sharp deceleration in global economic growth.
As the world gets ready to watch the BRICS nations, what will also be important for India are the bilateral meetings it will have on the sidelines of the summit. This also includes the bilateral between China and India.
Since the border war with China in 1962, the relationships have improved, and China is today India's largest trading partner. What kind of financial and economic cooperation are you wishing for between the two?
For that economic complementarity to materialize, there must be greater financial cooperation or relationship. For example, last year, the Reserve Bank had allowed Indian promoters of infrastructure projects to raise commercial borrowing in China in yuan. And that was in response to the demand for equipment here and the supply of equipment from China. I believe there is also a proposal for a bilateral swap arrangement and reserve pooling requirements under the BRICS umbrella. That's stemmed from the BRICS summit of last year, when they asked the governors and finance ministers to come out with a proposal, and I believe that that proposal is in the final stages.
Is the RBI planning any currency swap agreement with China at some point?
Not the RBI, but I believe there is a proposal under BRICS for a swap arrangement across BRICS countries. When that gets institutionalized, there will be a mechanism for a swap arrangement between India and China, because both are members of BRICS.
Governor Subbarar, thank you very much for your time. It has been a pleasure.